Hello and welcome to the Hotel Investors Marketplace produced by Hotel Brokers International. I'm Charlie Fritsch, President of HPI. The Hotel Investors Marketplace is designed to provide the most current information in franchising, lending, and valuation, as well as provide an opportunity to preview recently listed hotels and talk about hotel investment and transaction issues. While everybody gets signed in and comfortable, we'll highlight a few HBI member listings on the screen, and I'll provide some background information on this webinar. Hotel Brokers International is the leading hotel sales organization with more than 50 hotel brokerage specialists in the United States. Founded in 1959, the organization's broker professionals have successfully negotiated more than 10,000 hotel real estate transactions and annually account for 48% of all mid-market and economy hotel sales in the United States. Please visit HBI on the web at www.hbihotels.com. If at any time during the webcast our listeners have a question, just click on the Ask a Question button found on the gray bar located at the top of the webcast player. Type in your question and submit it. We'll try to answer as many as we can. Please let us know how we're doing. Rate today's webcast by clicking on Rate at the end of the program, which is found on the gray bar located at the top of the webcast player. Also, if you have a topic you'd like us to cover in a future webcast, you can suggest that in the comments section of under Rate. Later today, this webcast will be posted to the HBI website at www.hbihotels.com for on-demand viewing, and all of the hotels featured in this webcast are posted on hbihotels.com. So I'd like to welcome our panelists for today's discussion. Christopher Hearn, CEO and co-founder of Mercantile Capital Corporation. Welcome, Chris. Bob Hunter, CEO of Hunter Realty Associates, Inc., and co-chair of the Hunter Conference. Welcome, Bob.
Thank you. I'm glad to be here.
Good. And Robert White, President of Hospitality Appraisals, Inc. Robert, welcome.
Thank you. It's a pleasure to be here.
Thanks for joining us. So let's get started. First, I'd like each of our panelists to take a minute to briefly tell us about their professional backgrounds and involvement in the hospitality real estate industry. Chris, you want to go first?
Be happy to. Thanks for having me, Charlie. We started about 10 years ago. I've been in the small business finance sector for about 15 years. I actually went off on my own and started Mercantile Capital about 10 years ago. One of the many property types that we finance are limited service hotels. We do them all around the country. As I was saying before we got on this call, we've done more hotels in the last 16 months than we have probably in our tenure. Probably did about $45 million worth of hotel financing in the first quarter of this year already. So
great.
We think it's a great property type. We have some advantages, I think, over some of the conventional financing that may or may not be out there at the moment, and I'm sure we'll get into more of that on the call here. So thanks for having me, Charlie.
Yeah, absolutely. Thanks, Chris. Bob Hunter.
Well, thank you very much, and Charlie, and I'm glad to be here. Hunter Realty is a national hotel brokerage company. We have specialized exclusively in hotels since 1978, and as you have mentioned, we also produce a hotel investment conference each year, the Hunter Hotel Investment Conference. We'll be doing our 25th year next year. We just finished our 24th one, but it was a great success, and I'll get into that in a little bit.
Yeah, thanks, Bob. It was a great success. I enjoyed the conference. And Bob White. Robert?
Thank you, Charlie. I started my hotel career back in 1969, operated hotels for about 18 years, and then went to work for George Mumford at the Mumford Company and sold hotels for about 4 years and started this company back in 1990, and this is my 22nd year. So it's a pleasure to be here. I'm an MAI and also a certified hotel administrator.
That's great, and I appreciate the fact that everybody has a great depth of experience on this. We're looking forward to hearing from you guys your thoughts. So I've got some questions. Chris Hearn, if we could start with you, and Bob and Robert, if you have any thoughts on these questions, go ahead. Will hotel financing become more available in 2012, or is it already? And do you see underwriting changing?
Well, I think it will become more available as we get deeper into 2012, assuming we don't have any, unforeseen calamities that happen in the marketplace. And we could go through a whole list of things. New terrorist attack that could freeze the financial markets again, and God forbid, things like that. But I think hotel financing in general is thawing out a little bit. I think valuations are very attractive right now. Obviously, the interest rates probably have nowhere to go but up from here, so you have a lot of opportunistic buyers at the moment. I'd like to think, and I'm sure Bob White can comment more on this, but it would seem to me at hotels as a property type, a commercial property type, appear to be at the bottom of their cycle, and we're starting to see more people come in and want to take advantage of that fact right now. So, in terms of the financing, the banks, have they changed their underwriting? They have to some extent. Obviously, in 2009 was a pretty bad year in the financing arena, quite a bit. 2010 thawed out a little bit more. 2011 was a little bit better, and I think you're seeing 2012 start off a little bit better as well. But some of this is driven by the regulatory environment that we live in these days. For particularly the types of financing that I specialize in, which is the SBA 504 loan. Despite the fact that is one regulator, the SBA, the Small Business Administration, classifies that as an owner-occupied loan, a C&I loan. Unfortunately, some other regulators, whether it's the FDIC or the OCC or state regulators, oftentimes classify hotel loans as CRE or commercial real estate loans. Well, that has a direct impact on how a banking institution will underwrite these properties, and even if they have any appetite for it whatsoever, just because of some of the ratios that they have to stay within. So that's really put quite a chill on the hotel financing sector here over the last 3-4 years. But fortunately, banks have gotten much healthier over the last couple of years. Many have raised some capital. Many, fortunately or unfortunately, have pushed some folks out of the portfolio and brought some of the ratios back in line. And I suspect you're going to see some more opportunistic buying and financing of it here as we go further into 2012.
Great. Okay. Thanks, Chris. That was very thorough. Is Mercantile Capital Corp, you're a direct lender, correct?
We are.
That was a question from somebody in the audience. And they also asked, which was my next question, is where do you see debt service coverage ratios and loan to values on hotels right now?
Well, conventionally right now what I'm seeing is anywhere from, say, 55% loan to value up to as high as maybe 70. Occasionally I've seen a 75% loan to value. That's conventionally. Hard money, you could probably go a little bit higher than that. Of course, you have to pay for that, whether it's the additional fees or higher interest rates. The things that we do in the SBA space, and SBA unfortunately has gotten a bad rap over the years for a variety of reasons that were probably warranted. But the program that I specialize in, the 504, we're regularly doing transactions at 80 to 85% loan to cost. In fact, even doing refinances now at 90% loan to cost. And so, and we're doing transactions most of our transactions are in the $4 to say $10 million range. We just did a $12 million hotel project last month, for instance. So we can go outside of that. The other SBA program that some people are more familiar with, because banks tend to like this a little bit better, it's a little easier on the banks, and there's a nice secondary market for it, is called an SBA 7A. The problem with the 7A loan, unfortunately, is it's going to cap out at $5 million. So if you have a hotel project that's beyond that, you're probably only going to be able to look at the 504 marketplace or hopefully something conventional if your EBITDA is good enough, and if you're an experienced operator. So that's what I'm seeing right now.
Okay, great. And in debt service coverage ratios, what range?
Probably I'd like to see somewhere in the 1.4 times in the most current tax year. That would be helpful. I mean, I'm quite frankly, as I said earlier about the cycle and where we're at, I'm seeing some of the strongest hotel deals from a debt service standpoint that I've seen in my whole career. I'm regularly seeing things in the 2 and 2.5, 3 times coverage, which is pretty impressive. And for some reason, other lenders are still not comfortable financing some of these. I think it goes back to the regulatory comments I was making earlier. Yeah, there's a lot of nice projects out there. I mean, I really feel like occupancy rates have gone up, ADRs have gone up, and it's a great time. If you know who to go to and who the specialists are, it's a great time to try and get hotel financing.
Great. And Robert White, in your appraisals for when it's a hotel sale that's getting new financing, and Bob Hunter, in your transactions, are you seeing similar loan to values and debt service coverage ratios?
Robert, go ahead.
In some cases, we see them as high as 80%, particularly if they're SBA related, and it winds up being 2 loan components. Sometimes it's 504, and then another loan behind that. So the total loan to value winds up being, in many cases, as much as 80%. That's what I've seen. But most of the other arm's length, commercially related non-SBA loans are in the range that Chris had talked about, 50 to 70%. I've seen some at 65 and some at 70. I really haven't seen any at 55 yet, but yeah. Okay.
And Charlie, this is Bob Hunter. I support the comments and the ranges that the others have spoken of.
Okay.
That's what we're seeing from a brokerage point of view.
Okay. So anywhere, a pretty broad range from 55, 80, even up to 85%.
And I think that's important for the listeners to realize. It's who the sponsor is important. The product, the geography, the trends on the hotel. We're talking averages or typicals, and as we all know, nothing is typical and nothing is average. So it depends on the circumstances as to what's going on. And let me ask a question of the group, if I may. What are you seeing about personal liability, personal guarantees? What are being required today?
Well, for obviously any SBA product is going to require a personal guarantee.
Correct.
And frankly, I'm seeing even on the conventional side, again, if assuming you can get conventional financing for a hotel right now, I would almost assure you that you're going to be asked for recourse on that loan, even if it's just for a period of time and then burn off after maybe 2 or 3 years. But it's very common. Unfortunately, this is a property type that's worrying regulators considerably, and obviously worrying bankers as a result of that.
Good, thank you.
And Chris, and also Robert and Bob, I think this question I'd like to get answers from all three of you on. Do you think lenders who took back hotels the last few years or a few years ago will begin to put more of those hotels on the market this year or next year?
I think they're trying to put them on the market as quick as they can, to be honest with you. I don't think there's no advantage to holding it on their balance sheet, that's for sure.
This is Robert White. Yeah, I would agree with that. We're seeing we're getting appraisals that are basically FDIC updates, but we're also getting a fair amount that require an estimate to prepare the asset to be marketed. So
this is Bob Hunter. I'll jump in second of all that. As I mentioned earlier, I've been in hotel brokerage business since 1978, and therefore have been through several cycles. And as they say, the generals always fight the next war with what they learned in the last war. And what we learned in the last war was that things bounced back pretty quickly. So the guys who made the money, the lenders lost when they foreclosed, and the guy who bought it from them made the money. So the lenders said, well, we're going to we're going to hold on to these properties, and when it bounces back quickly, we'll be the benefactor. And well, it didn't do it the same way this time. It came back, but more slowly. The values got down to 40%. In RTC days, we were 40% was pretty much the value that hotels sold for. 40% of the peak value back in the early 90s. This time around, they said, "Well, we'll hold," and they were right. If the values got down to 40, maybe 50% of their peak values, the kick the can down the road, that the approach that many of the lenders took worked. Now, it didn't come all the way back, but it came back in many cases 70 to 70, 80%, and is now sort of flattened down. Is moving up from there. Again, this is averages and typicals and so forth. But what we're seeing then is that they've held on. They've now decided the kick the can down approach actually worked, irritated a lot of people. We all geared up for the big crunch and the buying opportunities, and the banks held on. They didn't take the big write-downs. Now that they're back to 70, 80%, they're saying, okay, we can now sell without taking such a horrible hit. We'll start to do that. We're actually seeing a rush at the low end of the market. Things below $2.5 million or so. There's a lot of those properties available, and the SBA will finance them. And because of that, the transactions are occurring a lot down there. And then if you want to call this a barbell market, at the top end of the market where the REITs were buying, all cash, they didn't need financing, they were buying. They had raised big funds. So we had the far end of both ends of the market, we had activity. In the mid-market, it was not so much activity. But nonetheless, the lenders, yes, are starting to shake loose their properties, and there could be a rush.
One quick note, we've launched our first poll question, and listeners will see those on their screen. Please do put your vote in, and we'll announce the results of those votes as we go along. We've got 5 poll questions that we'll put out there during the webinar. Thanks, Bob. And Robert White, you mentioned about doing appraisals for lenders. What percentage of your appraisal activity are you now are doing that's serving lenders who want a current appraisal on distressed hotels versus appraisals for new hotel sales and new financing for buyers?
I would have to tell you that the majority of our work is distress related, and in terms of a percentage, I'd probably have to guess somewhere between 80 and 85%. Either are on a watch list, as some bankers like to refer to, or they're in foreclosure, or they're in some kind of distressed condition. And then there have been very few in the way of new transactions or acquisitions in the way of purchases. We do probably 175 to 200 hotel assignments a year across the country, and that's pretty much what we're seeing.
And are you seeing that the distress activity, is it in major markets, or is it the secondary or tertiary markets, smaller towns that you're seeing that most of it?
I'm not seeing much in the major metro areas such as Philly, Baltimore, D.C., L.A., Chicago. I'm seeing a lot in some of the suburban, the more secondary and tertiary markets. Obviously, these properties on major interstates have took a huge hit, particularly in the early stages of 2009 and later that summer in 2008 when gas prices went up. But yeah, it's been primarily in the secondary and tertiary markets. The major markets really have fared pretty well in terms of demand, although they did take a pretty good hit on average rate.
Yeah. And Bob Hunter, the top markets seem to have recovered more quickly. Do you see secondary and tertiary markets coming back as well?
Well, Yes, but not as quickly and not as strong. And as Robert mentioned, they hadn't gone down as much, perhaps, and didn't have as much to come back. But the top 25 markets are certainly preferred. Even the top 10 are greatly preferred at the top end. Yes, the tertiary and secondary markets, have buyers, but the values are not as strong. Barriers to entry is a big topic in the top tier markets, and obviously out on the highway or in the secondary, tertiary markets, you don't have the barrier to entry situation. Obviously, we're all benefiting right now from the lack of new construction. From an operations point of view, the operator doesn't have a new hotel being built next to him that he's got to deal with. From a valuation point of view, buyers don't have to worry about the new competition coming in and taking some of their business. At some point, it'll come back, but we've had a window here of no new competition, or at least very limited new competition, and we think that's going to continue for a while.
Mm-hmm. And Chris Hearn, do you see, is market location, whether it's big market, small market, is that relevant to you in new financing today?
Well, our preference, of course, would be in the markets that are more established, that you can make a business case for. Obviously, we take a look at STAR reports to see what they say. If you're going to try and build a hotel, or you want to acquire a hotel in some fairly rural market along some interstate highway, and you don't have a very good occupancy history, I mean, we're gonna think twice before we want to do that. But again, it all depends on the price. You can make an argument for it. We're getting ready to close a transaction in Omaha, Nebraska, actually, in a couple of weeks. That's not normally a market that frankly, we've never done a deal in Omaha, Nebraska. But it's well located. It's near the University of Nebraska. There's a pretty good interstate highway system there. Omaha is a reasonably decent sort of second tier city, and so I think it'll be okay. But the further out they are, the more difficult it will be. On the other hand, in city center type situations, as some of the other gentlemen have said, the Bobs, they both said that those went down quite a bit. If an opportunistic buyer is purchasing it right, there can certainly be an argument to be made that it's gonna pan out for them, hopefully in the long run. Whether it's looking at their historical debt service coverages, what the cap rate is. I mean, there's a lot of ways you can make that work if you have a cooperative seller and a seller who's not thinking that they can sell the property for 2007 values. And most of them at this point, I think, are becoming a lot more pragmatic about the situation.
Mm-hmm.
And Charlie, let me interject here,
Bob,
if I may. I think one of the important things for us all to realize is that we're still a street corner business, and you read the national averages from PKF and Smith Travel and all these things, and they report how business is up and so forth. It still matters, what's going on your street corner. What brand do you have? What kind of management do you have?
Mm-hmm.
All of those factors. So when you ask a general question about tertiary markets or secondary markets, well, we all should say, well, it depends. Now, we're generalizing, but at the same time, we're telling ourselves, be careful about generalizing. Because
that's a great point, Bob. I'll just give you another example of a situation that happened about 3 months ago. We financed a Comfort Inn in Midland, Texas. Well, normally that wouldn't be a place we'd want to be, but the reality was it's near 100% occupied Sunday night through Thursday night because of all the shale oil workers that are out there.
Yeah.
I mean, there's an example of something that would be a little bit more of an exception. But normally we probably wouldn't have done anything in Midland, Texas. That's kind of out in the middle of nowhere.
Yeah, so local economies can vary a lot, and local can often trump national and global economy. Is that what you're seeing?
Absolutely.
Yeah. Our first poll question was, year-to-date on average, are the hotels you own or operate up in RevPAR in the first quarter of 2012 compared to the first quarter of 2011, even or down? 67% said yes, up over 10%. 17% said yes, up over 20%. and 17% said about even. So that's interesting, and I think a positive note that majority of hotels are seeing the RevPAR up 2012 compared to 2011. Is that what the three of you are seeing in the transactions that you're looking at? Is ADR occupancy producing a positive RevPAR increase?
This is Bob Hunter, and I would say, excuse me. I would say yes.
Bob.
I'm not sure that 4 out of 6. You just said 4 out of 6 are up over 10%, but we're seeing some of them certainly up over 20. Many of the properties, I think, again, it depends. At the low end, perhaps are not up so much, but the nicer properties, yes.
Yeah.
I'd second that.
Okay, Chris, that's what you see. And Robert White?
I would agree with Bob. In most cases, in most markets, we've seen generally modest increases, at least, in RevPAR. In most cases, the occupancy has been the primary driver for the increase in RevPAR rather than average rate.
And Robert White, if we can continue, how hard is it right now for you doing an appraisal to find comparables, comparable sales in the market, and is it harder to find them for distressed properties or for well-run properties?
Actually, it's hard to find both. I mean, we have a fairly sizable database, and we also subscribe to CoStar Comps and have a nationwide service relative to lodging hotel sales. We have been able pretty effectively, although it does require probably more research today than it did 3 to 4 years ago, to verify sales and also to verify the financial indicators such as cap rates and room revenue multipliers and occupancy and average daily rate. As you know, Charlie, we have relationships with you and as well as other brokers, and our preference is to try and verify data through brokers because the sales that they were personally involved in, they tend to have detailed data that's reliable, and that's our preference. But again, going back to your question, it's difficult to find, traditionally arm's length transactions in today's market. All properties we see have been distressed to some degree in that they've lost value. It could be anywhere from 25 to 50% in the last 3 years, and I think everybody would agree that that's pretty distressing. So when you look at the sales, what we have seen, which is kind of interesting, the better investment grade properties, the newer properties that became distressed, the properties that were built in 05, 6, 7, and early 08 and became distressed in 9, 10, and 11 appear to be selling at lower cap rates and are basically being purchased on pro formas because they see the ability. For example, we recently did a Hyatt place that was built probably at $135,000 to $140,000 a room, and was getting an average rate of $85. It's really hard to make economic sense out of a property that costs you $135,000 a room, and it should be getting an average rate of $115 to $120, to suddenly be getting $85 and be competing with a Fairfield Inn. So the people that are buying those, to coin a phrase, are basically buying those on upside. and are willing to buy them at lower cap rates or based on pro formas.
Guys, let's talk a little bit more about cap rates. How much are you seeing varying cap rates from larger to smaller markets? And Bob, Robert White, you just mentioned newer hotels are selling for, and I guess you're appraising at lower cap rates. So that, and also brand, how much is that affecting cap rates?
Cap rates are a function of basically two things. They're a function of the property and the market. Cap rates are nothing more than risk factors, in my opinion. And if the market's good, the location's good, and you've just taken a hit in occupancy and average daily rate, the risk is mitigated. And somebody might be willing to buy that at a somewhat lower cap rate. The properties that have taken larger hits and are in markets that have taken a real downturn, those cap rates, people are basically buying them on negative cap rates in some instances. A lot of those are owner-occupied, and people are basically looking for a job in many cases. They're buying 50, 60, 70-unit properties that in some cases really just have minimal NOIs.
Mm-hmm.
Charlie, if I may interject,
yeah.
Bob Hunter. What is it? Cap rates are something that Wall Street sort of revived, 10 years ago when they got in the market. And cap rates are for statisticians, I think. We have to be very, very careful because, again, we're generalizing. And I've always said, I'll let you name the cap rate if you'll let me name what we're capping. And I think if you have to ask those two questions together, you can't say what's the cap rate without saying what are you capping. Are you capping, pro forma numbers? Are you capping actual? Are you capping after a 4% management and a 4% reserve and a 3% management, or after 5%, or what? So what are you capping? And then how about the PIP? Are you capping before or after the PIP? So it's cap rates can be very misleading. And if I quote you, this is an 8.5 cap, you'll see the same transaction when the buyer said, I bought that at a 10 cap, and the seller will say, I sold that at a 5 cap. Same property, and you're looking at that elephant from two different views, and both of them think they're being honest and complete. But so beware relying on a single number in buying a hotel. A cap rate can be misleading.
Good point, and let's ask our lender how he views cap rates. Chris?
I'm sitting here. I was on mute. I was laughing actually at Bob's comments because I think he's spot on. I think it's you could ask the same question to the buyer and the seller and get completely different answers.
Yeah, that's funny on the same transaction.
Yeah, exactly.
And both of them think they're being honest. They're not puffing. They're telling you what they bought it or sold it at. Right.
And both of them feel like they got a pretty good deal, which is usually the hallmark of some decent negotiation.
Yes.
And Bob White, back to you. Do appraisers typically consider, Bob Hunter mentioned the PIP and whether the cap is before or after the PIP. How much do you consider the PIP that the franchisor is requiring in terms of your evaluation?
Typically, here's how that works. When the PIP is available, and it's generally not available, I might add. But when it is available, it winds up being a deduction from the value, particularly in a transaction that's under contract. You guys would probably know better than I would as brokers that a property gets put under contract subject to a number of things, one of which is the PIP. The PIP comes along, and if it's relatively minor, it's not a big deal. But if it winds up being substantial, then we have a second negotiation, do we not?
often.
Absolutely, absolutely. And it's interesting, as the market strengthens. I can remember years ago at one of the national conferences, I asked the question of this expert panel, is the transaction, do you add the PIP or not when you come up with the valuation? And the panel disagreed. Now, this was in the heyday. They thought, oh, it'd be $12 million, and the buyer pays the PIP, so he's really paying on $1 million. He's really paying $13 million. And the other guy would say, no, that's a deduction. Well, now that the market has declined, it's clear that it's the value, whatever price you all agree on, is $12 million, and then we deduct the $1 million PIP, and so you actually pay $11 to the seller and $1 million to the PIP, and you got $12 million invested.
That's correct. And that's typically how it goes.
Right. But that is one of the cap rates have gone up, and the PIP, how you handle the PIP, has changed.
One of the things that I'd like to add to that is that in some cases appraisers have been criticized for missing the value, and the appraiser didn't have or was not privy to the PIP and how much it finally totaled, and valued the property without the ability to make that adjustment to the final value. I would tell you that trying to get the PIP, for a property that's not under contract is very difficult. Getting the PIP for a property that's under contract, arm's length, is a lot easier.
So doing an appraisal without a PIP in hand, does that hamper you?
That's hard, yeah. Because the PIP is the unknown, and if it's substantial, it's going to impact value. It's going to impact that purchase price. So
let's spend a minute on the PIP comp. Now that you brought it up, Charlie, this is Bob Hunter. The PIP is extremely important, and you can see everybody's concerned about it. We as brokers, when an owner says he's ready to sell, one of the first things we ask him to do is go to the franchise company, pay for a PIP, and I will tell you, that in itself is an issue. They cost money. The franchisors are reluctant to, those who are reluctant to do it in a timely fashion. Everybody needs to understand that when they give you, let's say Hampton, you pay $5,000 for the PIP, they go out and perform it and hand it to you. What they give you is a bunch of words, no numbers.
Right.
Somebody then has to take those words and convert them to dollars and say, okay, it's going to cost $300,000 to complete this PIP, and so that in itself is a challenge. But if the owner doesn't order the PIP, then we have to go out and say, plus PIP, and we can't put a number on it. And there's always a disagreement. The owner thinks, oh, Hampton will only charge me $200,000. You can get it done, and the buyer says, oh, it'll be $400,000. And that's why we encourage take the argument out, take out the retrading opportunity later when we find out what it really is. So PIPs are very important from value, from the negotiations, from understanding what you're buying or selling. Not my opinion, your opinion, but the franchise company's opinion. That's the only one that matters. A PIP done, there's a term, a PIP done for transactional purposes at the time of sale is entirely different than a PIP that would be done for an owner who's going to keep it. It just wants to know what the franchise company wants him to do. That PIP is more modest and less demanding than the one at the time of sale, because the franchisor realizes that the time of sale is one of his opportunities to get the work done that he wants done. He's got some leverage at that point, and so he will be demanding of that. Also, I think we would all... Excuse me. Go ahead.
That's an excellent point, Bob.
Yep. I think we'd also agree that the franchise companies have been relaxed over the last several years on what they're demanding or requiring of their owners. They understood the owner was struggling to pay the mortgage. He didn't have money to renovate. Now that the economy's improving, owners are improving, the franchise companies are starting to say, okay, guys, we've been understanding for the last several years and letting you get by with some things that we really thought needed to be done. It's now time to catch up. and so they're starting to be tougher and less understanding and less willing to look the other way. So again, that just makes the PIP larger. PIPs are often deferred maintenance as much as anything.
Yeah.
So
one sale we worked on recently, we saw on a Hampton Inn, the PIP had been put out to 3 different professional supply companies to price, and there was a wide range of quotes on fulfilling that PIP on a Hampton Inn, and so you can only encourage owners and buyers to go out and shop the costing on everything on the PIP widely in order to get the best deal.
Good point.
Chris Hearn, let's say after the PIP, the appraisal comes in too low, and Robert White, you can comment on this as well. Does the borrower have the ability to argue the value of the appraisal, or what happens? Where do they go from there?
Well, they can certainly try. I mean, the reality is, on all these transactions, the lender is going to engage the appraiser in most cases, and so it's to the borrower's benefit to be involved in that process, to know what's coming back. Hopefully, the banker will share that information with them. And yeah, if there's a shortfall, then certainly you got to dig in and try and figure it out. Were the comparables too far away? Were they the wrong comps? Just a variety of different things. And obviously, your fallback position is always to go back to the seller and say, well, you know what, you're being unrealistic here, and either we need to renegotiate the price, or maybe you need to take back some seller financing or something. But that's, they certainly can try. I guess that's your question. Certainly they should try. They should stay involved in the process, and whether they're going to be able to convince the appraiser that maybe they made a mistake here or there or what have you. Again, I hate to keep going back to this. Everybody keeps using this, but it all kind of depends on the situation. I mean, appraisers are human. They sometimes make mistakes, although I will tell you most of the time they're pretty spot on. And and if there is any massaging that can be done on the appraisal, it's probably at the fringes anyway. Oftentimes there's a disconnect between what the seller thinks the property's worth and what the buyer thinks the property's worth, and frankly, you just don't know until you have an independent party such as an appraiser get out there and put a value on it.
Yeah, some appraisers may make a mistake, but I'm sure Bob White never makes a mistake.
I've never known Bob to have made a mistake.
That's close.
and Robert White, is there any discussion on the value, or when you come out with it, is that it? It's done.
Yeah, here's the issue is it depends on the scope of services that the lender required. For example, if they know a PIP is pending, they're going to ask you for an as-is value, i.e. no PIP, and then they're going to ask you for an as-complete value, and some of them want an as-stabilized value. Mm-hmm. Most lenders, depending on what the disconnect is and how distressed the property is and where the value is on an as-is basis versus as-complete, will give some credence to the as-complete value in making the loan, depending on what the buyer's asking for. So the scope of services are really important, because if the PIP is large and the market and this property is underperforming, then if the guy's going to put a $500,000 or $1 million in, you really need to take a look at what impact that's going to have on the property in terms of value.
Yeah, those are all good points.
And this is Bob Hunter. Let me make another practical, real-world point about PIPs, and that is, what does a PIP cover? What is a PIP? It's a property improvement plan, but it includes what I call the pretty stuff, the stuff that the customer sees. But it doesn't include the behind-the-scenes mechanical stuff. My best example is the elevator. The PIP would include if the elevator cab is ugly and dirty and beat up and needs fixing, then the PIP will cover that. But if the elevator motor is slipping and breaking and not working well, that's not part of the PIP. That'll be a mechanical item that is above and beyond the PIP. The PIP inspector doesn't go back and check the boiler. He doesn't check the laundry equipment. So those are, I want all of our listeners to realize that PIP is a component. It's a part of what needs to be done. It's what the franchise company is requiring. But you've got to decide if the boiler is functioning, if the elevator motor is working properly, if the air conditioner is working. Those are above and beyond a PIP.
Right, and the roof, unless the roof is leaking in a room and impacting the guest experience, the PIP inspector won't cite it, but it may be not leaking right now, but it could be aged enough that you really need to take that into consideration. Robert White and Chris Hearn, do you consider when appraising or lending on a hotel, the age of the facility and sort of unscheduled or maintenance that isn't included in the PIP?
Absolutely. We look at the age of the hotel, if it's been recently renovated or not. What type of the hotel, if it's interior corridor or otherwise. We like to analyze the borrower's personal liquidity to determine, do they have adequate reserves for future maintenance? If it is an older property that hasn't been renovated recently, all those considerations do go into our underwriting. Absolutely.
Mm-hmm. Another question we ask the audience: from which market segment of hotel guests are you seeing the biggest increase in demand? Half of the voters said corporate, 17% group, 17% leisure, and about 14% transient or other. And the interesting thing is here, we also had a government as a demand segment, and nobody said they're seeing any increase in demand from government. And I think that's a testament to the fact that states and federal budgets are probably shrinking and going to continue to shrink.
I would agree with that.
Yeah.
You didn't have a category for GSA on there?
No, not specifically.
That was a joke.
Yeah.
That was a joke. Yeah.
Maybe not. No, maybe not.
Good. Yeah. And Chris, along the lines of the PIP and improvements or brand changes, how does a lender perceive that in terms of what requirements you might ask for relative to the PIP? Do you, when in an SBA 504 loan structure, I assume you're always escrowing the PIP, and how do you monitor how that PIP is executed?
Well, we look for the franchisor to finally sign off on it. You're correct. A lot of times we'll escrow the funds. It's easier to do one disbursement if there's if the borrower has liquidity to cover it. If we have to do a draw schedule, we've done that in the past as well, much like a construction loan. I'm not sure what you asked at the beginning there, Charlie. What do we look at? Obviously, we prefer situations where a borrower is going from a lesser brand to a better brand. Clearly,
Mm-hmm.
that's what we're always
gives you something to believe in the upside.
Yeah, exactly. And I think it's I think it's responsible. I think it's obviously it shows some optimism on the side of the borrower. Hopefully, going from a situation where you have one ADR level to a significant bump, that's something that we're always trying to look at. You'll if you're in that situation as a borrower, as a potential buyer, you're going to find the lending world's going to open a lot more doors to you than if you're going the other way. From a mid-market sort of brand downward, it's going to be a little tougher. You're going to find very few people want to go that direction.
And if they're basically up branding, but sort of within the same segment, but from kind of the bottom of the segment to the upper end of the segment, sort of like from mid-scale to upper mid-scale.
Yep, that's positive as
maybe
well.
from if we would a Ramada or a Clarion to Holiday Inn. Would you see that as a up branding?
Absolutely. Absolutely.
Okay. Bob Hunter, what are the key issues from the broker perspective in successful transactions and dealing with the franchise, maybe relative to the PIP, and also with financing and appraisals?
I think the key things are good communications, good information, as much information as you can gather from everybody early in the process, and then the broker's got to deal with all these. We're sort of the experts in many fields. We got to be able to talk to Chris in financing and talk to Bob on the appraisal. Talk to the franchise companies about PIPs. Can you keep the brand? If so, how long? Certainly talk to buyers and sellers. Certainly know what's going on in the market with comps and everything else. And the reality is, if you go up to 35,000 feet, look where we are right now. At our conference, the appraisal group made the point that their opinion we're about 7 o'clock on a clock. If you think that the hotel industry, and agree, we all sort of do, that it's a cyclical business, and that we've just come down from midnight to 6, and we're now on the way back up at 7 o'clock. Now's the time to be getting in from where you are on the cycle. You look at financing, and Chris will tell you, hey, the cost of financing, you can all look at interest rates, is historically at an all-time low. You can buy and renovate a hotel today below what it would cost to build it, and on that point, new builds are way down. Nobody's, not many people anyway, are building new, so you won't have that new competitor to compete with for a while yet. So it's a perfect storm on the upside, if you will. Good time in the cycle, low interest rates. I think we all think inflation is probably just around the corner. And if you look at the classic way to deal with inflation is to have a hard asset. And hotel certainly is a hard asset. And as inflation comes in, we're not tied into 5-year leases like an office building might be or a shopping center or something. You've got a 24-hour lease. And as inflation dictates, you can raise your rates on a daily basis if need be to deal with inflation. Meanwhile, the value of your underlying asset should be reacting positively to inflation. So it's a great time to be a buyer. If you come through the hard times in a position financially, or maybe you're new to the industry, or maybe you got out at the right time and are looking to get back in, your timing is beautiful. You've got to not listen to the daily noise of what's going on in Spain or something. You got to look at your market again. Back to it, we're a street corner business. Analyze the factors of your particular property you're looking at to buy, and look at the situation. What's the brand? What's the age? Knowing that you're generally at a good time in the cycle to be a buyer. So I think those are all factors that buyers should be looking at and feeling good about.
So the devil or the upside or the heaven perhaps is in the details.
Yes, the upside to heaven is in the details. The particulars that apply to yours, yes. Yep.
And Bob, you mentioned new builds. I'm curious to hear what Chris and Robert White think if there are new builds that are planned, and let's say they're even under construction, and you're appraising or about to loan on a hotel, and there's another hotel being built just down the street. How do you assess that risk or that potential impact?
Chris, you want to go first on that? This is Robert White.
Go ahead, Bob. Quite frankly, we're not doing too many ground-up construction hotel projects for obvious reasons. And a lot of them
I mean, if you were lending on a hotel that's existing, but you know that there's a new hotel under construction, let's say next door.
Well, it's going to depend on, what category of brand they are for starters, and what kind of RevPAR they're going to get. Some of the factors we talked about before about where are they going to get their customers from? If they're in a corporate office park and one of them has historically had a 90+% occupancy, well, that would be suggestive to me that maybe there wasn't enough rooms in that corporate office park, and maybe the market can't absorb 2 hotels. There's just so many variables to look at in that situation. Hopefully I'm financing the one that's already there right now, because back to Bob's comments a few minutes ago, I fully agree with everything he just said. This is a buyer's market, and you can buy a hotel, even if it needs some extensive renovations, far cheaper than you can construct one from the ground up. And that's why you just don't see too many construction projects going on right now.
Yeah. Bob White?
New construction is very, very costly. It's not uncommon for the middle tier Fairfield Inns and Hamptons and Comforts and properties like that to cost, north of $100,000 a key, depending on where you're at and what the land value is.
That's right.
So you really have to have, occupancy and average rate working in concert to produce, a level of RevPAR that'll make economic sense. In most markets today, if you spend $120,000 a key to build a property, you need an average rate north of $100 to make some money at it. And the occupancies really have to be, in most instances, typically depending on what the average rate is, but low to mid 60s up, preferably closer to 70 plus. In order to make some economic sense out of it. And then you really have to understand how much unaccommodated demand is in that market. As Chris said, if you have a property doing 90%, you can be sure that they're probably selling out anywhere from 4 to 6 days a week, and those people that can't get in a room at that property are going somewhere else. So trying to identify how much unaccommodated demand is in the market and, where those demand generators are coming from is a fairly detailed analysis.
I'll tell you, this is just a little bit of light humor here, but always beware of the financials you get that show 106% occupancy. I actually had a hotel about 13 years ago that was presented to me in such a way. And there's only a few ways that you can actually even get to 106% occupancy, and I won't say them on this call, but if you want to email me after the fact, I'll explain it to you if you haven't figured it out.
Yeah, Chris, actually, I did sell a hotel that legitimately could do 110, 120% occupancy in some months, and this was some years ago, because it had corporate trucking contracts, and those truckers wouldn't stay in those rooms more than 12 hours, and some were in there at night and some in during the day.
Yeah. And therein is the beginning of the rabbit hole to go down if you want to figure out how you get there, is charging by the hour.
Yeah. So let's talk about the future a little bit. Robert White, specifically, what do you think will happen to the overall value of hotels, let's say over the next 5 years, and why? And do you think larger economic factors are going to be really important, or what do you see as the most important aspect that would impact hotel values in the next 5 years?
Well, I see values typically moving up modestly over the next probably 1 to 2 years, and then more aggressively after that, because as somebody just pointed out a while ago, I think there's going to be some inflation. And once we restore our average rates to the level that they were back in '06 and '07, then I think you're going to see some exponential increases in value, which I think will probably happen, 3 to 5 years from now. One of the most important considerations for us in the lodging industry, employment drives a lot of our boat. And there hasn't been a lot of that recently. That's why you're not seeing, any substantial increases that have been published by any of the authorities, including, Smith Travel, except in a few markets. On a nationwide basis, demand's been increasing, more or less modestly. Okay. I think as employment returns to its former levels, I think you're going to see more aggressive increases. But for right now, my own opinion is we have about a 2% population growth in this country the last time I looked. And I think that's one of the most important indicators right now. I think what you're seeing in the way of increase in occupancy is primarily the result of increasing population.
Yeah, it's got to increase demand for rooms, that's for sure, as we have more people moving around the country.
Yeah.
In terms of the future, Chris, what do you see? And Robert White was saying he thinks we may be in for some inflation. What do you see in, let's say, over the next 5 years as far as rates? And of course, one great thing about the SBA 504 program, the SBA second mortgage piece is always fixed rate, which is great. And so you want to talk about rates for a minute, where they are now, and where do you think they may be going in the future for the next 5 years?
Sure. And I'll just to comment briefly on what he said about the future. I would generally agree with his assessment. I think he's pretty spot on. I think we're going to tread water a little bit here for the next 2 to 3 years, perhaps. I do think inflation is going to eventually come in. I think it has to. I think I can remember years ago. I'm sure everybody on the call can remember this, when sort of the start of the information, the communication technology boom. People were saying at one point, there's not going to be the business traveler anymore. Everybody's going to do video links and Skype and all this other stuff. And while that has increased, I think the overall communication has increased. I don't think that's really cut out the need for face-to-face meetings. And I think you're going to see as corporate balance sheets can't get much more flush with cash than they are right now. I think they're at an all-time high since World War II. But you're going to see people getting out there and meeting each other and doing more business together. And I think you're going to see the business traveler increase, and that really bodes well for the mid-market brands. But in terms of interest rates, I mean, again, without talking for the next hour about how we got here and where we're going from here, I think we're probably going to be in a holding pattern for the next year or so. The Fed's already basically telegraphed that. I don't think it's going to. I think the Fed was saying until 2014. I don't think it's going to go that long before you're going to start to see rates rise. I think it'll probably happen in the early 2013s. But we are very, very far below the historical average on commercial property. Just over the last 50 years, commercial property, all property types, the interest rates averaged about 8.5%. I mean, we're doing transactions for hotels right now. They're in the high fives. That's a tremendous opportunity if you're on the buy side. And I think they're gonna creep up from here, but I don't think it's gonna be a major leaps and bounds. Prime is artificially low. All the short-term rates are artificially low, of course. You were saying a second ago, I think, Charlie, about the 504 second mortgage piece. That has been trending at near all-time lows for the last 2.5, 3 years.
Yeah, what is it right now? Around 4.5 or?
Yeah, right now it's about 4.5 fixed for 20 years. It's usually about 350 basis points over the 10-year Treasury yield. Just going back over the 30-year life of the program. So that's usually a good thing to look at. And then in terms of what you can be at for the first mortgage, again, every lender is going to be within a range, usually not more than a 25 to 50 basis point range. But that's probably going to be, about a point and a half above what the debenture rate would be on a 504 loan. So you're probably going to be in the mid sixes to could be as high as low sevens right now. And you blend all that together, and you're going to be right at about 6%, which is again just a tremendous advantage if you're a buyer, if you're a borrower right now, to be able to get capital at that price point. Really bodes well for down the road because the prices, the interest rates are going to go up from here. And if you can lock that in today over the next, say, 12 to 18 months, I think you're going to look back at this low interest rate environment and probably kick yourself that you didn't buy more stuff if you had the opportunity.
Right. Yeah. Thanks. Bob Hunter, as far as transactions to the rest of 2012, 2013, in the future, or do you see increased transaction volume? And
Charlie, the answer is yes. We had our best year ever as brokers. We're a national company, but we had our best year ever last year in 11, and this year starting off strong. We had our conference, as you and I mentioned earlier, about 4 weeks ago. The attendance was the largest ever. I think that means it's a hotel investment conference. I think that speaks well for the confidence of the community. And in general, we ask you to check a box on what part of the industry you're involved with. We had 46 people check the box that were hotel lenders. So there were 46 lenders there, which is a huge increase from the recent past years when nobody wanted to come out and have to, tell everybody no.
Right.
So that was a good sign. The mood was confident. The mood is not crazy confident. It's cautious. And I told, as part of my opening remarks, I said I've taken cautiously out of the common phrase of cautiously optimistic. I'm just now optimistic. Hey, I'm not wildly optimistic, but I'm no longer cautiously optimistic. I'm just optimistic. And I think that's sort of the mood. We've all looked at the factors that affect that. We see the lenders are there. They're collectively deciding and not just talking, but putting their money where their mouth is. The lenders are confident. The REITs are out of the market, and that's been a good thing for the rest of us. You don't have to compete with people who are buying things with low cost capital, even lower than what everybody else is. So the fact that the REITs are out of the market has calmed down price-wise. So it's a good time for buyers. All those other factors we talked about, low interest and buy below replacement costs and those things. The fact that the REITs have withdrawn for a while because they can't buy on the open market or at least sell more stock on the open market to buy with. So it's just a good time. The mood was good. The transactions are happening. That's other people voting with their dollars that they agree that it's a good time to be a buyer. Yeah, there's some black swans flying around up there, but we just have to, that's noise. We just have to ignore that. There'll always be that. This is not a low-risk treasury. There's risk in buying hotels, but gosh, the reward can be so good.
And Bob, as far as the demand to buy hotels, is that, let's talk about types of properties. Is it mostly limited service? Who and are any buyers going after larger full-service properties? Where do you see people gravitating to?
Large full-service properties are harder to sell. They're harder to finance. Chris would, say it's harder to finance. Again, unless they're in one of these top 7 to 10 markets in downtown big city USA, those are strong. But if you're in a secondary city with a large full-service hotel, there are fewer buyers for those. The PIPs are big. Large number of rooms means more risk. Again, it's back to the particulars. What brand are you? How big's the PIP? How realistic is the seller? The vast volume is in the lower third of the market, the lower quarter of the market. The top quarter was hot in the past. It's the middle 50% that is, we think, will now be starting to come back. Where the banks will start letting those go, where the owners we'll start saying, okay, I think the values are up off the bottom at that 40 to 50%. Now they're up to 80% or so, and we can start selling those. Historically, we've done each end of the barbell recently. The mid-market, we think, will start coming back slowly, but it's going to start coming back.
Mm-hmm. And Chris and Bob, and would you agree? It seems like, and Robert White, you would think then, from what Bob Hunter was just saying, that barriers to entry would be a lot higher on full-service properties, which, for those that can handle them, which it does require a whole different level of management skills, I think, but you'd think that that would attract people to the right full-service property. How do you view full-service versus limited service? Bob White in appraising and Chris in financing.
Well, first, there's typically less demand right now for full service hotels. Mm-hmm. The issue with full service hotels is that their net operating income ratios are a lot smaller than the mid-tier limited service properties, whose NOIs typically can range from anywhere from 33, 35 up to 40% of total sales, where net operating income for full-service facilities that have extensive food and beverage operations are more in the 17 to 20% range. Mm-hmm. So people figured out a long time ago when they started building out limited service hotels that they were getting a bigger bang for their buck, from a limited service property, because the profit ratios were just higher.
Yeah.
Yeah, I would generally agree with that. I mean, there is less demand for full service. Obviously, with us specializing in SBA 504 loans, until about a year ago, that meant we really were restricted to much smaller projects, generally in the $6 million and below. Nowadays, however, they've increased the caps on what is government guaranteed dollars, and quite frankly, on the 504 side, that means we can go to $12, $15 million total projects. We just did a $12 million full service hotel at the Salt Lake City Airport actually last month. And so, but again, I think Bob's correct. It's just there's not as many buyers. You think about the life cycle of a hotelier. A lot of times they'll get into the business, in many cases buying a non-flagged hotel, a much smaller hotel, and then they trade up. And eventually, I think there's a tremendous opportunity right now to trade up into those middle tiers, the limited service hotels, the things that are in the $3 to, say, $8 million range. Those are the things that you're going to get the most advantageous financing for. And we've already discussed it, up to 80-85% loan-to-cost financing. Quite frankly, you're getting interest rates fixed probably longer than anybody has done, even in the CMBS market. And that market hasn't entirely come back anyway to finance some of these projects. And they aren't really interested in too many of the limited service hotels. They really want to do more of the full service stuff. So it's just, as Bob said, it's kind of a perfect storm on the upside. I call it sort of the once-in-a-generation opportunity that, 18, 24 months from now, we're going to look back on this period and say, well, now we're more of a normalized world. Where interest rates are in the 7 to 9%, and the advance rates are not quite as advantageous. Cap rates have maybe come down some. I mean, they're just the things are going to be different a couple of years from now. But I think right now it's very positive if you're a potential limited service hotel buyer.
Mm-hmm. I'd like to add one thing to that. The select service market is becoming more and more popular in terms of development and acquisition. The Hilton Gardens, the Courtyards, the Hyatt Places, the Indigos, their profit ratios are considerably higher than larger operations that have extensive food and beverage, including conference space, etc. The NOI ratios for properties that are what we call select service with limited food and beverage, such as breakfast and dinner, are typically in the 30 to 33% range. Some more, some less.
Right.
So that is becoming a target for many buyers today.
Our first question we answered, if I can inject this. I was curious.
Before we leave,
okay, go ahead,
Charlie. Let me throw one to Chris.
Yeah.
Chris, if I'm a potential borrower for a hotel loan and I'm coming to you, what guidance would you give me as far as being prepared when I come to see you? Should I just walk in the door and say, "Hey, man, I'd like to borrow some money," or to buy a hotel with, or maybe a little bit more sophistication? What would you tell a borrower to come in the door with?
Well, they can certainly do that, and I get plenty of folks to do that, Bob. I am a small business lender, so sophistication is there's definitely a range, a continuum there. We hold a lot of hands, but no, obviously lending is. I was about to say this anyway. I'm glad you brought it up. Lending is not all science, as some people think. I mean, there's a lot of art to it as well. Early on the call, I said that, we like to see 1.4 times debt service coverages. I can make an argument, and actually I could give you examples of situations this year that we've financed hotels where it's 1-to-1 debt service coverage. Okay, so it all kind of depends. You want to present your best foot forward, as they say. Give your best impression. You don't want to come in there with papers disheveled that you're pulling out of your sport coat and your briefcase and everything, and coffee stains on them and everything else. You're just going to start the whole conversation with a potential lender off on the wrong foot. It's best to be prepared. It's best to know that you're going to need to show probably 3 years of tax returns, personal and corporate, if assuming those are available on the corporate side. You're going to need to show interim financial statements, balance sheet, income statements. You're going to need to show your personal financial statement of anybody who's an owner, generally 20% or more, who's somebody who's going to be a guarantor. It's helpful to have some of that information. You're going to need to have, hopefully you're going to have some experience, or you're going to have a plan to hire a development company, a property development management company. Otherwise, you're probably just shooting yourself in the foot. I mean, somebody to go from something completely outside the realm of being a hotelier to suddenly jumping in because it's opportunistic time to do so and to buy this type of property, you're going to have a difficult time with lenders. I mean,
so experienced borrower is a key thing for you.
Well, yeah, you said it earlier. Going from a guy who's successfully and profitably run a Ramada Inn to now he wants to go and buy a Courtyard and trade up, that's going to be looked upon with a lot rosier glasses than somebody who's just getting into the industry. No question.
And if somebody's involved in the industry, if they're an AHLA member or a HOA member, and they've got experience, you view that a lot stronger situation than somebody who doesn't have that involvement and experience.
No question. And, they don't even necessarily have to be an owner. I mean, we've financed numerous people who have been managers of a property for a number of years, and now they want to get in, they want to be an entrepreneur. And we're big supporters of entrepreneurs. We love to see those situations. But they have to run it successfully. They have to be able to demonstrate that to us, and hopefully have built up some personal liquidity so they can do this. Yep.
We asked our audience, are you a member of any of the associations, organizations? 38% said AHLA, 38% said AHOA, 13% members said state or local association, and 13% said franchise brand or owner association.
Good.
So, yeah. And our last question of the day. Let me read that. Have you heard about the new restaurant on the moon that has great food but no atmosphere? 11%
no, I haven't. Tell me about it, Charlie.
11% said no, they haven't heard of it. Nobody said yes. Actually, 44% said, I think I ate there once. 44% said this joke was stupid but funny. And, hey, nobody said, I have no sense of humor, and neither does the person who wrote this joke, which is good because I was the one who wrote that joke. So, Guys, I really want to thank you for your time. I know you're all...
Charlie, before you wrap this up...
Please, go ahead, Bob.
Can I throw in one thing, and that is for folks who are thinking about selling, the tax laws looks like they're going to change the end of the year. I just want everybody to be aware that the 15% capital gains tax is looking like it's going to expire, and I don't know that the Congress and the President will do anything, January 1st. And the Obama health care is going to add 3.8% tax to capital sales. So if you're contemplating selling, and don't let taxes drive you, but if you're contemplating selling this year, and if you recognize that, unlike the stock market where you can call up the stockbroker and sell it, and in 4 days get your money, it's done. It takes probably 6 months is what you ought to plan on for a transaction in the hotel world. If you're going to sell this year, and if you don't want to pay more taxes, you ought to be talking to your accountant, finding out what the tax impact could be on waiting until next year. All I'm saying is if you're thinking about selling next year, you ought to look at the tax situation to decide if you want to accelerate that a little bit. But that's a topic that ought to be explored.
It's a great point.
And in that regard, Charlie, I just want to throw this out, a gift to everybody who's on this call. If you're looking at buying or selling, we actually just released an app for the iPhone. We're actually going to come out with one for Android probably here in the next 45 days. But for the iPhone at least, or iPad users, it's a free app for anybody who's on this call and wants to go to the App Store. It's called the Smart Choice Loan Calculator, Smart Choice Loan Calculator. You go there, you can download it for free. Literally within 2 to 3 seconds, you can figure out what the biggest questions I hear from everybody, which is how much of a down payment am I going to have on this property? What's my monthly payment going to be, and what's my rate going to be? It'll give you exactly what you're looking for, a range, of course, on the monthly payment and the rates, but it does it specifically. Hotel is one of the property types that we finance quite extensively, and it's right there. It's really easy to use, and I just encourage y'all to sort of know a little bit of what's it roughly going to cost before you go out shopping for it. I think that'd be very helpful.
Yeah, that's great. And how do people get that app?
They just go to the iTunes App Store and type in Smart Choice Loan Calculator. It'll pull up, and it's free for everybody on the call. Smart Choice
Loan Calculator. Cool. Great. And Robert White, any last comments from you, Bob?
It's nice to know that we think the market, notwithstanding any major calamities, has bottomed out and is now improving. And I think the fact that we've established at least stability in 2010 and then some modest growth in 2011, and now at least for the first quarter in 2012, will bode well for everyone moving forward. I would think that there would be more transactions relative to buying hotels, simply because I think people will have more confidence.
It's great. It's a good upbeat point, and sounds good to me. Bob White?
Yes.
Thank you. Bob Hunter, thank you. Chris Hearn, thank you very much. Great job, gentlemen. I'd like to remind everybody to don't forget to rate today's webcast by clicking on Rate, which is found on the gray bar located at the top of the webcast player. You can put in comments and suggest future topics also. As a reminder, this and previous Hotel Investor Marketplace webcasts are available for on-demand viewing online at hbihotels.com, and you can tell your friends about it. They can go to hbihotels.com and listen and look at this webcast and others. All of the hotel offerings that you've seen scrolling through are available on hbihotels.com. If you're looking to buy, give us a call. HBI will be exhibiting at the AHOA Annual Convention and Trade Show May 2nd to 5th. If you're attending, please stop by HBI's booth at number 741. HBI will also be exhibiting at the Choice Hotels International 58th Annual Convention May 15 to 17. And if you're attending, you can find us at booth 612. So again, thank you, gentlemen. I really appreciate your time.
Thank you, Charlie.
Thank you. Everybody, have a great day.
Yeah, you did
All
the
right,
same.
you too. Take care.
Thank
Bye
you.
all.